By Degen Investing.
Comparing trading in cryptocurrencies and stocks, it's simpler than ever for people to begin their trading experience thanks to the development of mobile investment apps and the expansion of online markets. A global trend in retail investing has arisen, supported by digital culture and accessibility. This is partly because big retail brokerage firms made the industry-wide decision to reduce their commissions to zero, which may have been the inevitable result of decades of regulatory policy development. Stocks and cryptocurrencies both have similar mechanics and technical analytics and are typically liquid, highly speculative assets. For instance, you can place comparable orders on both markets, such as market, limit, and stop-loss trading order types. A stock, also known as equity, is a security that reflects ownership in a firm or corporation and a proportionate claim on its assets. This is where they fundamentally diverge. Cryptocurrencies are wholly digital assets without any physical parts. According to a recent poll, 35% of US retail investors feel that cryptocurrencies may deliver greater gains than stocks, citing stock market risk as their primary justification. Additionally, 30% of respondents asserted that equities are preferable to cryptocurrencies. 4 out of 10 retail investors in the UK, however, do not believe that equities are preferable to cryptocurrencies. So let's compare the advantages and disadvantages of investing in cryptocurrencies against stocks. Transfer and ownership, the underlying difference between what you are buying when investing in the stock market vs the cryptocurrency market is the most significant differential. Although the stock market plays a significant role in resource allocation, both directly as a source of capital and indirectly as a gauge of a company's worth and borrowing power, shares only account for a small portion of a company's ownership. Depending on how many shares they possess, this allows the owner to own a portion of the corporation's assets and revenues. The use of cryptocurrencies varies greatly. Although cryptocurrencies permit 24-hour trading and minimum trade amounts, their architecture results in investors' ownership of a coin but not always a legal stake in it. Additionally, the cryptocurrency marketplaces provide instantaneous and secure ownership transfers using electronic private keys without the need for paper documents. A crucial component of cryptocurrencies, private keys enable you to transmit and receive cryptocurrency without the need for a third party to verify transactions. Cryptocurrencies use the public key cryptography (PKC) framework, which includes these keys, to encrypt and decrypt transactions. The majority of PKC instantiations employ commutative semigroups with computing powers or computing power products. You can utilize private keys to send cryptocurrency to anybody, anywhere, at any time by using PKC, which is a method of authenticating transactions through asymmetric encryption. This specific transferable digital representation's cryptographic scheme tangible thing. Stocks have the distinct advantage of representing a real, physical asset to support your investment. Although cryptocurrencies may be used to pay for goods and services, they remain a mostly unregulated asset class. A physical asset has transactional value. The majority of governmental and judicial bodies do not view cryptocurrencies as legal cash. In a recent draft bill titled Cryptocurrency and Regulation of Official Digital Currency 2021, India is recommending a ban on private cryptocurrencies. Similar to this, China, the second largest economy in the world, has put a prohibition on domestic financial institutions utilizing or trading in cryptocurrencies. This implies that 2.8 billion people, more than a third of the world's population, would no longer have access to cryptocurrencies if the federal government's draft cryptocurrency regulatory bill takes effect in India. This will hinder the industry's ability to reach a larger audience. The trading of stocks and options, however, has increased at a dizzying rate recently, with equities markets reaching record highs in February 2020. According to a National Opinion Research Center research from the University of Chicago, just 13% of Americans made crypto investments in 2021, one of the most important differences between stocks and cryptocurrencies, according to James Royal, a market analyst, author, and senior writer at Bankrate. is what underpins them. A stock merely represents a small portion of ownership in the firm. According to Royal, who told Capital.com that a stock's performance is determined by the performance of the underlying business, the stock's value rises as the company grows. Cryptocurrencies, on the other hand, are completely speculative and lack any tangible components. Because of this, some of the top investors in the world, like Warren Buffett and Charlie Munger, have vocally opposed cryptocurrencies. Size and turbulence. The usage of cryptocurrencies has increased amid growing public interest in reaction to perceived problems with the current banking and payment systems. Issues that were notably highlighted during the 2008 global market meltdown. This is demonstrated by the fact that, according to statistics from CoinGecko, the total market value of all cryptocurrencies reached $3 trillion for the first time in November of last year. From $500 million in December 2012 to $782 billion in December 2020, the total market value of all cryptocurrencies increased at a compound annual growth rate, CAGR, of more than 150%. The volatility of cryptocurrency markets may be used by investors to weigh the advantages and disadvantages of trading cryptocurrencies versus equities. Many experts are saying that the current wave of cryptocurrencies is similar to the Internet revolution and the development of the World Wide Web in the 1990s. But in contrast to the 20% corrections in the stock market, we're still looking about 85% dumps for the major cryptocurrencies during a bear market. The size disparity between the stock market and the cryptocurrency market is one of the reasons for heightened volatility. Consider the US equities market, which is estimated to be worth $53.37 trillion in 2021. With a $2 trillion market valuation, as of writing on January 12, the cryptocurrency market is more like a pond. In conclusion, we can say that since they were first introduced during the previous several years, some cryptocurrencies have seen huge price increases, but investors need to know what they are buying in rather than blindly following other traders. If you want to invest in cryptocurrencies, think about how it aligns with your personal risk profile and financial requirements. Without investing in cryptocurrencies, investors may generate respectable profits, and some illustrious investors, like Warren Buffett, will not touch the technology. Be smart, be Degen, and subscribe to our channel if you liked this video and want to know something more about it. Thanks for watching.